Very looking forward to talking with my next guest, Don Vialoux, tidingthemarkets.ca. Don does a fascinating variety of analysis where he looks at the cycle trends and he looks at the technical trends of different stocks, different sectors. And Don, you must have had a busy week, and I appreciate you finding time for us here.
It was an amazing week, Mike. It's time to celebrate. We saw the election of a pro-business president in the United States, and the Dow went to an all-time high. You got to love it.
Well, it's funny. I just said that with Michael Levy, with all the bombast of Mr. Trump and some of his, extreme statements regarding Muslims or building a wall in Mexico, et cetera, et cetera. What was lost is that his actual platform domestically has some very positive elements for it. And as you say, we saw that manifested after the initial drop. I mean, I'm watching this from back east like you were, and my goodness, you see the Dow drop 900 points in the before market trading out of Asia in the futures market, and then wow, that rebound just produced the best week in about 5 years.
Just quite amazing. The question now is, where does the markets, particularly the United States, move from here? And there's a history of this going back over the last 90 years. Historically, after the dust is settled, like we've seen this week, the markets in the United States move higher right through until Inauguration Day. So you've had a major uncertainty removed, and that's a positive, and investors start to anticipate all the good things that the new president is going to do. So on average, the Dow Jones Industrial Average goes up about 3% between now and Inauguration Day, which is, in this case, it's going to be January the 20th. Now, your former guest was talking about covered call rights. Classic opportunity to buy covered call rights right now with the idea of having them expiring late in January when Inauguration Day comes along. The reason why you want to choose January for those call options to write is that just after Inauguration Day, right through until around the middle to end of March, investors say, uh-oh, what did we just do? We've got a new president with a new mandate, and whoops. Historically, just after Inauguration Day, U.S. equity markets move lower right through until middle to the end of March because of questions about who's going to be the next cabinet minister, so on, etc. However, the good news is that once we get to around the end of March, equity markets once again resume their upward trend, and they go higher right through at least until the following summer. So we're set up here for an interesting possibility. The timing of your conference has to be ideal. You get a nice little bump in the upside between now and, say, the end of January, or January 20th, and then a little bit of a correction, which will give your investors an opportunity to do some buying by, say, the middle of March, and then we start to have fun on the upside.
Well, I'd like to take credit for picking the dates there. I have in a past year, by the way, with an eye to certain things like the drop in the oil price. But this year, no, it seemed to work well. So if I said I was going to take credit for that, Don, I'd be struck by lightning in this minute. So, but I think it does. I mean, come on, the volatility and the major changes we've experienced over the last few years make virtually any date a pretty good date. But I love what you're saying here, that we get this immediate bump after Inauguration Day, then we get a little weakness, and then we recover into that more traditional summer period. I forget what the trend is in the first year of a new president's mandate. Does it traditionally overall for the year go down, overall go up?
On average, from the low in, I'd say, March to the end of the year, the market actually slightly outperforms on average for the 4-year cycle. So it actually does provide an excellent opportunity to buy.
Let's look inside some of the areas there. Are we coming to the end of the sort of gold buying season right now, or have we already ended it? I look at August and September have been traditionally pretty strong months, and we got them right through into September. I think a 1360 high or thereabouts, and now weakness has certainly developed.
Yeah, let's look at gold a little bit closer and what drives gold prices for a seasonal trade. Historically, the best time to be in gold and gold stocks is in the summertime because something happens, some sort of an extraordinary event occurs during that time. It happened again this year with Brexit, when gold had a nice little spike there for a while. But the price of gold and VIX are tied at the hip. When VIX starts to move higher, gold prices move higher. And we saw this recently, for example, prior to the election last week, we saw gold prices actually moving higher. The key is that once the reason for the VIX going higher disappears, like we saw with the election last year, then the price of gold goes down. And we've seen that again this year. In fact, late last week, we saw gold and gold stocks break key support levels. Now, the question is, when is going to be the next time to invest in gold and gold equities? My guessing is it's going to be just after Inauguration Day in late January, when you get this period of uncertainty, and that's going to set up another spike in the VIX, and that's going to provide the opportunity to once again to buy gold and gold stocks.
I'm talking with Don Vialoux, timingthemarket.ca, and he'll be with us. I'm so looking forward to this at the World Outlook Conference. Does a fantastic job, as you can hear, just talking about the various things that should overlay any decision you're making, in the markets. We've talked about the broad market, talked about gold. I just want to keep throwing a few things out at you, if you don't mind, at this point, Don, just to get some snippets here from you. And let me go to the base metals right now. I'm looking at copper. Is had a very happy week.
Yes, in fact, it's not just copper. You've seen higher prices for zinc, for aluminum, for nickel. They are all in a year right now, and there's a couple of reasons for that. One of the big reasons is that we are expecting a recovery in the U.S. economy, and that's going to be increased demand for base metals. But also something else that's kind of been a sneaky one. China, if you look at what the Shanghai Index has done over the last month, it's up 6.5%. It broke out of just a gorgeous triangle pattern just last week. China looks like it's starting to recover very nicely. Now you say, well, wait a minute, isn't Trump going to be doing something against China? Well, the key is that Trump is a negotiator, and what he's going to try to do with China is to negotiate greater access of American products into China. Ultimately, that's positive for both the U.S. markets and for China. So looks like China's in gear. That's putting the base metals in gear as well. And we've seen strength in other things like the fertilizer stocks. Similar kind of idea. The whole idea is that these commodities kind of prices are starting to move higher because of what's happening partially in China, but also what's happening in the United States.
Well, economically, one of his main platforms also has to have an impact here, which is maybe he's been listening to Justin Trudeau. Just kidding. But, he's pushing the big infrastructure story, too. Major infrastructure spending. And, in quotes, his idea is to put Americans back to work out of the blue-collar jobs. And, infrastructure will be a very visible way of doing it if he runs into Michigan or something, runs into Wisconsin, Pennsylvania, and announces, we're going to build 25 roads or 3 sewers or whatever you've got. But he certainly has talked a very big game about major federal support for infrastructure programs, which, again, at some point has to be translating through to higher commodity prices.
Yes, the commodity prices look like they want to go higher. Even crude oil prices will probably start moving higher by the end of the year, but not yet. We won't get past that OPEC meeting before we start talking about that. One thing you may want to look at
as a teaser right now.
Is
Sorry, just hold that for a sec, Don.
Yeah, go ahead.
And I'll leave that as a bit of a teaser right now because I'll come back. I've got to take a break. I'll come back and we'll start with oil with Don Vialoux, timingthemarket.ca. And a reminder, I'm broadcasting today down from Orlando, Florida at the Economic Conference here. But many thanks to the Wyndham Hotel chain who have made this possible. Fantastic tech guy here named Andrew Berg set me all up today. So my thanks to the Wyndham Hotel chain. I'm at the Wyndham Bonnet Creek. I'll take a break. I'll come back. I've got Don Vialoux with me. We're going to go oil. I'm going to ask him about the bond market, too, because that looked like a major shift going on there that could have huge repercussions for virtually everything in the economy and your portfolio. So all of that coming your way on the Money Talks Network. Reminder, go to moneytalks.net. Patra Srizna talking about options coming to Calgary and Red Deer next Saturday, right through to Vancouver on the 25th, and get details there. Vancouver's the 26th, by the way. It was the 24th is Thursday in Victoria, Surrey, Edmonton. Check the dates out, but it's free. Go learn about options. Right now, Don Vialoux on the line, timingthemarkets.ca. Don, let me just fire right at you a couple things, because I think there's some big stuff happening. Let's start, though, with oil. Obviously, tons of interest in this country on oil prices.
Yeah, on a seasonal basis, crude oil prices historically reach a very important low around the end of the first week in December, and that just is after the OPEC meeting, and so that's seemed to be a reasonable expectation this time. On a seasonal basis, crude oil has its best period from the middle of February right through until around May of each year, so it's a little bit too early to make that call. But the good news here in Canada, as a result of the election of Trump, is that it looks like Keystone will be getting the go-ahead, at least has a better chance of doing that, and that's going to be good for Canadian oil producers going forward. So that's an encouraging factor. A couple of other things related to the election and how it impacts our Canadian investment market is that it looks like NAFTA is going to be renegotiated. That could be problematic, should we say, but we'll find out whether or not that's going to be a plus or a minus. But there were some minus things, too, which came out as a result of the election. You saw the equity markets in Canada not enjoying it very much. In fact, the Canadian market actually went lower after Trump was elected, and the Canadian dollar dropped almost a cent. So Canadian investors are not as positive to the election as U.S. investors. And in particular, if you look at the Canadian forest product stocks, it looks like now with a Trump presidency, there's a chance that negotiations on the softwood lumber deal will be much tougher. And that's why the forest product stocks here in Canada, particularly the Western producers, were hit late last week. So be aware that not everything out of the election in the States is positive, but there's enough positive things between now and January the 20th that you can still consider investing in Canadian stocks. We typically have a Christmas rally between the middle of December to early January. We're probably going to get that here in Canada once again. So it's not all bad. There's some good there as well.
Well, the softwood lumber was literally the first thing I thought about, when I'm thinking the economic implications of the Trump presidency, because I'm worried they might become the sacrificial lambs to sort of prove out his bona fides, to the blue-collar, unionized private sector, and then be more reasonable on the Canada side of NAFTA. I'm not speaking for Mexico, but the Canada side of NAFTA. I know that's just a thought. We'll have to see how it plays out, but I'm worried for the softwood and the lumber, as you just said, Don. Hey, I got to finish with this, though, because I think it's so important. I'm watching interest rates in the bond market in the States, and to me, I'm just wondering, have we finally seen the change? Have we finally seen the high in bonds, in other words, the low in rates? Is that what the bond market's telling me?
Oh, yes. We saw a huge increase in the yield rate last week. The bond prices got really munched quite strongly. I guess looking at some data here, let's see here, bond prices last week were down just 7%, and the yields went up over 20% just last week. So it looks like we've seen the bottom in yields. Bond prices are starting to head lower, and that's probably going to continue as we get into the next FOMC meeting, which is the middle of December. Looks almost certain that we're going to get another 25 basis point increase at that time.
And it may be a warning to people that, a lot of people on variable rate stuff, I know Canada isn't exactly the same. We're not in a position to raise our rates. I don't see that happening, but still, it's fair warning that maybe there's a shift, at least in interest rates. And the other side of that, Don, is, if the U.S. is raising their rates, and plus the bond market has already reflected that and more, doesn't the U.S. dollar just become far more attractive for those negative yield countries, investors like, throughout Europe, for example?
Well, it turns out the timing is exactly right now, because historically the U.S. dollar relative to the Canadian dollar goes higher between the beginning of November right through until around the end of December. So that means it implies weakness in the Canadian dollar between now and at least the end of this year. So if you're planning your holidays down south, could be an opportunity to do something now instead of waiting to pay a higher amount by the end of December.
Well, especially when you look at fundamentals, as you just alluded to, but also what you've just said about the oil price. If that's, seasonally, kind of hits its low around early December, I mean, that will also be a negative backdrop for the Canadian dollar. So people should be prepared for that. I mean, there's just so much stuff happening all the time now, and that's why I'm really looking forward to having you at the World Outlook Conference. I mean, I'll tell you, you're gonna have trouble just trying to decide what to talk about. There's so much happening.
Well, that's the thing. There are so many things happening right now, and it's a great time to be a part of that conference coming up in February. We'll mention
great
one other
stuff,
thing.
Don. And you, please, yeah, we've got to be quick.
Yeah, one concern that I have about what happened with the Trump election is that now the Americans are, shall we say, pretty neutral when it comes to the environment, whereas we have a pro-environmental political agenda here in Canada. The implication is that costs here in Canada are going to go up when they're not in the States, and Canada becomes less competitive. So be aware that that gives the U.S. investor or investors in the U.S. an advantage over investors into Canada.
Many thanks, Don. We'll talk to you very shortly. I'll get more